Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, I've got a little thought experiment for you. Would you lend money to this dude? He's the head of a household, and that household earns $52,446 a year. It spends $73,378 a year, running a $20,932 annual deficit. His total liabilities and unfunded promises amount to $1,361,788 against just $60,554 in assets, leaving this household in a $1.3 million hole. Now, I don't know about you, but there's no way on God's green earth I'd lend that guy a dime. And you know who that is? It's our buddy Uncle Sam. I kid you not, that is the current fiscal condition of the U.S. government if you divide each number in the 2025 consolidated U.S. government financial statement by 100 million, essentially dropping 8 zeros to make the data comparable to a household budget. So, yikes. I mean, it seems less than ideal, doesn't it? By the way, hat tips to Forbes for that little thought experiment. So I'm going to expand and expound on the actual Treasury Department data. But first, I do want to thank you for listening to the show. As always, I do appreciate it. I say this every week. I mean it, though. I know there are a lot of things out there vying for your attention, a lot of things for you to listen to. So I appreciate the fact that you spend a little bit of time listening to this show. And if you're finding value in it, maybe you could help spread the word. Like, share the episodes on your social media channels. Write us a review. Give us those stars or those thumbs up and help boost our algorithm so that we can reach more people. If you would do that, I would really, really appreciate it. But again, just thank you so much for taking a little bit of time out of your day to listen to the show. So, here is the ugly truth. The United States government is insolvent. Now, this isn't hyperbole, not some kind of exaggeration for effect. In fact, I'd argue that it's actually an understatement. And my conclusion is based on the plain reading of the Treasury Department's recently released consolidated financial statements for fiscal year 2025. So basically, we're talking about the U.S. government's income statement and its balance sheet. And the U.S. government ended the year with $6.06 trillion in total assets against $47.78 trillion in total liabilities. Now, for you non-accountants out there, that's not good. To put it in simpler terms, the federal government has $7.90 in liabilities, $7.90 in debt for every dollar it has in assets. So if the United States government were a private business, it would be in bankruptcy court, no question about it. So the release of these financial statements got virtually no attention in the mainstream financial media. Forbes was one of the few publications to actually highlight the numbers. There were a few that piggybacked onto the Forbes report, but for the most part, this report that highlights America's abysmal financial condition was met by, quote, near total media silence. That's how Forbes put it. Based on Forbes' reporting, the U.S. government's financial position deteriorated by $2.07 trillion in fiscal 2025. That's bad. $2 trillion, over $2 trillion in fiscal deterioration last year. The balance sheet now stands at an unfathomable negative $41.72 trillion. Don't skip over the negative sign. That carries the entire weight of this story. The federal financial position was further eroded last year by a $2 trillion increase in the national debt and interest expense payable, now at $30.33 trillion, coupled with a $438.8 billion in federal employee and veteran benefits payable. So those are the things that are kind of driving these deficits and this massive debt. By the way, what I'm talking about here doesn't even include the unfunded liabilities of Social Security and Medicare. Like, I'm not even going to try to get into that. But ugly is the first word that comes to mind. Unsustainable is the second. Oh, crap is the third. Well, that's two words, but you get the gist. I used the word insolvent earlier, and you may think, well, that's an exaggeration. We're not really insolvent, but here's the definition of insolvent. So consider it for yourself. Quote, a financial state where an individual or a company cannot meet debt obligations as they fall due, or that has liabilities exceeding its assets. So the government actually meets both of these conditions, right? It cannot meet its debt obligations as they fall due. It has to borrow more money. This whole U.S. government is basically a giant Ponzi scheme. It is borrowing money from new borrowers to pay back old borrowers as those bonds come due. And at some point, that house of cards is going to collapse, right? Forbes argues, quote, the reckoning, long deferred, is becoming impossible to ignore. Now, this is the part of the story I think Forbes actually gets wrong. It apparently is not impossible to ignore because the mainstream continues to ignore it. Most people continue to ignore it. Pretty much everybody in Congress is ignoring it. Donald Trump is ignoring it. Everybody's ignoring it. As already noted, the Treasury released this data to the sound of crickets. And this is typical. When we get these shocking reports about the national debt, about the government's financial condition, there's always a few people that'll sit up and take notice. You know, there's a couple of predictable folks in Congress that will talk about the debt, but everybody else pretty much just shrugs, and business continues on as if everything were fine, right? Yeah, every once in a while the media points out the problematic fiscal situation. You'll get an article from a Forbes. You'll get some bloggers that'll talk about it. Senator Rand Paul, Representative Thomas Massey, and a few like-minded colleagues might bring up the issue in Congress. Democrats will sometimes talk about the national debt as a prop to simp for tax increases, but really, that's about it. Mostly people just act like everything is fine. And I think the mentality is, we've had this national debt for so long, and, people have been warning about it and talking about it. Nothing's really happened, so everything's fine. Ladies and gentlemen, everything is not fine. Now, I will grant you, this has certainly been going on for a long time. I kind of got interested in politics in the early to mid 90s. So that's when I was kind of coming into my adulthood. I graduated from college in 1991. So, I was starting to pay attention. And those of you who are of a certain age will remember that time period was when the Republicans, led by Newt Gingrich, were pushing for what was known as the Contract for America, or the Contract with America. I can't remember the exact title. But the whole thing was a giant push for a balanced budget, a giant push to get the debt and the spending under control. And Republicans swept into Congress based on these talking points. And we actually saw some budget surpluses in those years, which was a combination of kind of the demilitarization of the U.S. in the wake of the Cold War. We didn't have to maintain a giant military to face down the Soviet Union anymore. So that definitely helped. And there was a concerted effort, or a kind of an effort, to cut Congress, or cut spending by Congress. And so that was a big thing, right? This was a huge political movement at the time. Balance the budget, deal with the debt. You know what the national debt was during this era? It ranged between $4.5 and $5 trillion. Today, we are at $39 trillion. We will be at $40 trillion before the end of this year. So yeah, this has been going on for a while. And so I get this idea that, well, everything's fine. They were warning about this back in 1995 and nothing happened. And then we had the Tea Party movement and the Republicans were worried about the spending and the taxes then. And everything's fine. No, it's not. There's really no effort to deal with this fiscal malaise. No, raising taxes on the rich isn't going to solve the problem either. I've actually run the numbers on that. I'll see if I can find the article and link to it in the show notes page. If you could take all of the money from all of the billionaires in the United States, and it wouldn't even run the U.S. government for like 6 weeks. So yeah, taxing the rich isn't really a thing. The sad truth is that virtually nobody in Congress or the current administration or the out administrations or anybody is serious about tackling the root of the problem, and that is government spending. Right? Now, Democrats will tell you, we've got a revenue problem because of the Trump tax cuts. Revenue's up, ladies and gentlemen. I don't know if you noticed, but we've had these tariffs, and that has significantly boosted the federal revenues. So I believe federal revenues are up somewhere in the neighborhood of about 10% so far this year, but not helping because the spending just keeps going up. In total, Uncle Sam spent $3.1 trillion through the first 5 months of fiscal 2026. That was a 2% increase over the same period in fiscal 2025. Think about that. 5 months, they spent $3.1 trillion. What does that even mean, right? A 2% increase in spending. Okay, that doesn't sound all that significant, but wasn't I told that there were going to be spending cuts? Well, now, to be fair, there were some spending cuts. It's true. The increased spending comes despite cuts to the EPA and the Department of Education budget. This was, I think, part of the big, beautiful bill. So those are starting to show up in the data. Lower disaster spending last year also helped moderate spending levels through the first couple of months of fiscal 2026. Keep in mind, the fiscal year starts in October. But looking at the big picture, the spending trajectory is still up. Even with all of the hype about Doge and, some lip service to cutting spending during the early days of the Trump administration, the U.S. spent just over $7 trillion last year. That's an average of $583.3 billion per month. So over $500 billion being spent every single month, or $19.2 billion per day. Oh, and ladies and gentlemen, now there's a war. So that's going to add to the spending. I've seen anywhere, estimates running up in the $200 billion range. Nobody really knows. We'll see. But this is going to increase the spending even more. And that's the reality of things, right? Sometimes they'll talk about spending cuts, and sometimes they'll even do some little trimming of the budget here and there, but there always is a new excuse to spend money. There's always an emergency or a war. You can just kind of guarantee it. So, whatever the budget is, you can just kind of mark down that the spending is going to be even higher because they're going to have to spend money on these extra things. And when there's an emergency, nobody really resists. So I kicked off the show comparing America's current financial situation to a household. And I guarantee you that somebody listening heard me at the beginning of the show and said, well, Mike, you can't compare a government to a household. After all, the U.S. has a credit card with no real limit, and it can print money. Furthermore, since the dollar is the reserve currency, it can print and borrow to its heart's content. So just quit talking about spending. You're just a meanie who doesn't like the government. I don't like the government. I don't know if I'm a meanie or not. I might be. I don't know. But that's the messaging you get when you start trying to make this comparison. And they'll say, oh, no, you can't compare the government to a household. It's a bad analogy. Okay, maybe it's not the best analogy. I will concede that, yes, a government is fundamentally different than a household or even a business. But Like, come on, right? When people say this to me, they're trying to convince me that like I'm overhyping it or I'm talking about a problem that doesn't exist. I'm sorry, when you're $40 trillion in debt, that's a problem. I don't care if you're a government or not. And anybody with an ounce of sense who doesn't have some kind of agenda to protect the sanctity of government has to look at this and say, this is a problem, right? So if you're telling me this, to ensure I understand the nuances of government finance, thanks, I got it. But if you're just saying it to make America's fiscal malfeasance seem more palatable, just stop. Again, anybody with an ounce of sense understands that the U.S. fiscal situation is bad. It's unsustainable. And at some point, if it's not dealt with, it's going to deal with us. And I'm not even talking about a situation as drastic as a default, right? Even if the government can keep kicking the debt can down the road for years, this fiscal situation has ramifications. It is impacting our economy. I've seen studies that say that when you get above 90% of GDP, when debt rises to above 90% of GDP, you start to see impacts and contractions in the actual economy. So we're at like 120% of GDP right now and rising. So this is undoubtedly impacting the economy. Our natural economy would be bigger. We would be wealthier. We would all be doing better if the government wasn't sucking up so many resources through all of its borrowing and spending. Just look at the interest problem, right? The massive debt and the relentless deficits are precisely why the Federal Reserve can't really raise interest rates to battle inflation. The massive debt black hole is why I think that the Fed is actually going to cut rates much more sharply than anybody's expecting right now, right? We have this narrative in the mainstream that, we've got the war, that's causing oil prices to go up, that's going to cause inflation, so the Fed is going to be, hawkish, it's going to fight that inflation, it's going to hold interest rates higher for longer, this is bad for gold, sell your gold. As I said in the show last week, I don't think this is a very good case against gold. If you haven't listened to that show, I urge you to do so. But that's the narrative right now. And it's detached from reality because they're ignoring the debt black hole. They're ignoring the fact that a debt-riddled bubble economy cannot function in even a normal interest rate environment. This is going to put pressure on the Federal Reserve to cut. And yeah, I think they'll hold the line, while they can, as long as there's no major cracks in the economy. But I tell you what, if the economy starts to collapse, and we're due, as I've talked about on the show so many times, when that happens, what is the Fed going to do? It's going to have to choose between inflation and rescuing the economy. And it's going to pick rescuing the economy. I can almost guarantee it because that's the fork it knows. That's what it does. We saw it in 2008. We saw it during the pandemic. We even saw it to some degree in 2018. If you recall, we had a steep stock market correction. And what did the Fed do? It immediately cut interest rates and went back to quantitative easing. And of course, as I've talked about on the show before, we're doing quantitative easing now. The federal government is printing money. It's doing it right now, right? We're not in a tight financial situation. We're not having tight monetary policy right now. I did an article this week that's published over at moneymetals.com/news on the real inflation rate and looking at the money supply. So I'll link to that in the show notes page. I'm not going to dig into that here. But what I'm driving at here is that this debt is impacting monetary policy because of the interest rates. Interest on the national debt cost $1.2 trillion in fiscal 2025. Think about that. $1.2 trillion was forked out by the U.S. government just to finance all of the borrowing. That was up 7.3% over 2024. And interest is now the second highest spending category for the federal government, only eclipsed by Social Security. The federal government is spending more money right now on interest payments than it is on national defense or on Medicare. Now, that may flop a little bit. We may see a big jump in national defense spending with the war. But in general, just think about what that's saying, right? All of the things that the government does, The second most expensive thing is paying interest on the national debt. How is this sustainable, right? Again, this is one of the reasons why I believe the Fed will continue to cut interest rates this year, despite rising CPI, despite an oil price shock. If they don't, the debt black hole will eventually suck the life out of the U.S. economy. And that leads to the second problem that I alluded to at the start of the show. Who wants to loan this guy, Uncle Sam, more money, right? The United States depends on the globe to soak up some of this debt. I think somewhere in the neighborhood of 40% of the national debt is held by foreigners. So that's a lot of people out there that are looking at the United States, they're looking at this fiscal situation and going, maybe I don't want to do this. Maybe I don't want to hold on to this debt. Is this really going to pay off in the long run, right? I've written extensively about de-dollarization. America's fiscal irresponsibility is one of the factors driving the so-called debasement trade, right? This is reflected in declining demand for treasuries, rising treasury yields, even when we're in a period where you would expect people to be buying treasuries because of the war. You know, they used to be perceived as a safe haven. But what is safe about loaning more money to somebody that's $40 trillion in debt? So this is a significant thing that's going on. And I want to touch on another thing too. Sometimes you'll hear folks say that, well, the debt doesn't really matter because we owe it to ourselves, right? We owe the debt to ourselves. And yeah, some of that debt, a lot of that debt, the majority of that debt is held by American individuals and corporations. It's in your pension funds. You know, people buy treasuries, people buy them for their grandkids. So yeah, it's true that a lot of Americans are holding debt, but it's not, we don't owe it to ourselves. This is something that kind of derives out of this nonsense that we are the government. No, we're not. The government is its own entity. It does its own thing, right? We are subject to the whims of the government. We're not the government. I don't owe myself any money. And if I did, yeah, sure, it wouldn't matter. But that's just not a thing. It's one of these talking points that you kind of hear it and go, oh, yeah, we do owe it to ourselves. So it's okay because it's also an asset. You know, and that's the whole basis of modern monetary theory, MMT. You know, it's this idea that we can print money forever because we have a printing press. We're the reserve currency. Yeah, we might need to worry about inflation a little bit, but not really. You know, that's the theory. It's dumb. And a lot of it's based on accounting tautologies. Now, I have an accounting degree. I mean, I'll grant you, I wasn't very good at it. But I do have an accounting degree. I do understand accounting. I can read financial statements and make sense out of them. And I can tell you that the accounting tricks that the MMT people use to prove that we can borrow all of this money is nothing but accounting trickery. And I understand accounting enough to know that, you know, when you're making the rules and when, you can manipulate and make decisions about how I'm going to categorize this or that, you can make financial statements look better than they are. And accounting can be used to cover things up. And that's really what the MMT people do. It's really not a sound monetary theory at all, but they've managed to package it in a way that it sounds plausible. And quite frankly, it's hard to debate because some of these accounting tautologies appear to be valid, even though they're not really telling you what they think they're trying to tell you. So we've got this declining demand for Treasury and rising yields. And besides raising interest rates, to deal with this, the central bank is probably going to have to continue to run quantitative easing operations. As I mentioned, it already is, because it has to create artificial demand for Treasuries. That's one of the points of quantitative easing, right? The Federal Reserve buys bonds out on the open market. They buy them with money created out of thin air. That's key, right? It's not like they have a bank account with a bunch of cash in it and they're trading that for bonds. No, they're literally writing checks out of an account that has no money, and the money is created when the check is written. Okay, so no, Jerome Powell isn't in the basement of the Eccles building, printing off $100 bills. But that's how money printing happens. It happens through this quantitative easing. Money supply increases also happen when interest rates are lower because it increases borrowing. And when we have a fractional reserve system, banks can loan out more money than they have. So again, these new loans expand the money supply. So interest rate cuts and quantitative easing are both inherently inflationary. And inflation is already on the upswing, right? I'm not talking about price inflation. I mean, inflation is historically defined as an increase in the supply of money and credit. As I said, I did an article on that this week that I'll link to in the show notes page. And, this inflation part, that's the part of the equation your MMT people and others who poo-poo worries about the national debt seem to miss. Yeah, the government can print money to its heart content. However, it is constantly devaluing the currency to the detriment of its own people, and that is not a sustainable strategy. And it's also based on the fact that people in other countries want to have dollars, right? That's really the prop that has kept this entire system held up for the United States government. It is the fact that the world needs and wants dollars. We have the petrodollar, right? Dollar is the primary currency used in the oil trade. So people need to have dollars to buy oil. We've exported all of this currency, right? We send dollars to China. China sends back products that we use. And then they use those dollars and they invest them. What happens when they don't need the dollars? As I've said repeatedly, the dollar doesn't have to lose its reserve status to create significant problems for the U.S. economy. Even a modest de-dollarization could spell disaster. If the world needs fewer dollars, they'll begin to return to the U.S., right? Other countries are going to say, you can have these dollars, we don't need them. We're going to keep gold in our reserves, right? It's going to cause a dollar glut. All of this demand for dollars, if it sags, if nobody wants dollars, well, the dollars are still there. They're not going away. So it's just going to increase the inflationary pressure here in the United States as the value of the U.S. currency further depreciates. And, worst case scenario, the dollar could collapse completely, leading to hyperinflation, right? Zimbabwe is not something that's impossible for the United States. It's not likely because of this whole reserve currency thing, but it's not impossible, right? Any fiat currency can collapse. And quite frankly, every fiat currency, I believe, eventually will, because governments can't help themselves. They abuse their fiat currencies. They print so that they can borrow, so that they can spend, so that the government can be bigger and more powerful, and you're paying that inflation tax. So, go ahead, feel free, act superior, laugh at Forbes' unsophisticated comparison between the government and household finances. You might be technically correct, but you're missing the point. Everything isn't fine, the debt matters, and those proverbial chickens will eventually come home to roost. Just because they haven't caused a problem yet doesn't mean that they won't. You see, the problem with playing kick the can down the road, and that's what we're doing with the debt, kick the can down the road. The problem with that game is that eventually you run out of road. And so that's why every single week I remind you that you need to save in real money. You need gold and silver because the dollar is doomed, right? Whether it dies in a blaze of glory someday or by a million little disinvestments, it is losing value every single second. I emphasize this often. 2% debasement of your currency is the plan. Every 5 years, they want your dollar to buy 10% less than it did 10 years ago. That is the plan. So you need to shield yourself from that. If you're saving in dollars, you are being subject to this relentless depreciation of your money. So might be a good time to check out our specials over at moneymetals.com. If you go to the top bar, you'll see a section that says specials. You just click on that. I kind of want to highlight random 1 ounce silver coins. So these are either 0.999 or 0.9999 silver. And we've got these coins right now for as low as $4.99 over spot per ounce. If your orders are under 10 ounces, it's $5.99 over spot. It's a good deal for silver. These are government minted 1 ounce coins, random designs we choose, but it's a great deal to get pure silver. And I would say that right now, silver's running in the high 60s, low $70. We've seen silver as high as $120. The dynamics in the silver market aren't changing, right? They're not suddenly creating more silver. And the fundamental issue with silver right now is there's not enough of it. There's not enough metal. And, it's not like anybody can go out there and poop metal, right? That's a problem. We've had this consecutive years of market deficits where the amount of silver being pulled out of the ground has not met the amount of silver used. That's not changing. So I think that there is still more upside potential for silver and gold as well, especially once we get through the volatility of this war. So check out those specials, check out those silver coins over at moneymetals.com. So here's a question for you. We know that one of the things that makes gold valuable is its scarcity. But just how much gold is there? Have you ever thought about that? How much gold is there in the world? I bet there's not as much gold. I bet if you were to guess, if you don't know already, I bet if you were to guess, you would probably guess that there's a lot more gold in the world than there actually is. So put a number in your head right now. How many tons of gold do you think have been mined throughout all human history? So based on best estimates, geologists at Metals Focus estimate that there are 219,890 tons of gold currently above ground. So that's basically all of the gold that has been mined throughout human history. Gold isn't easily destroyed. It's almost never destroyed. So virtually all of the gold that has been mined throughout history still exists somewhere. So we're talking a little bit under 220,000 tons. Now, that sounds like a lot, but if you melted that gold into a cube, it would only measure 22 meters on each side. That's about 73 feet on each side. That's a pretty big cube, but think about it. That's all of the gold in the entire world. So to give you a better visual, if you took all of the gold in the world, you could melt it down and fit it inside 4.5 Olympic-sized swimming pools. Again, not very much gold, right, in the big scheme of things. Now, Metals Focus estimates that there are about 54,770 tons of mineable gold reserves. This is gold that they know it's there underground. They know they can get to it. It can be extracted. They're economically viable to extract under current market conditions. The U.S. Geological Survey has a slightly larger estimate of 64,000 tons. So still quite a bit of gold underground that they can get to that will eventually be mined. Furthermore, based on geological evidence and sampling, Metals Focus estimates there are an additional 77,340 tons of known gold deposits that aren't extractable under current economic conditions. So the gold is there. We know it's there, but it's either too deep or too difficult to get to mine profitably at this point. The World Gold Council notes, quote, estimates of below-ground reserves have remained stable for decades, even as gold is being continually mined out. So that means, in practice, that the pace of new gold discoveries tends to roughly correspond with the amount of gold that is pulled out of the ground each year. So how much gold do mines produce on an annual basis? Well, last year's mine output set a record of 3,672 tons. It was a 1% increase over the prior year. But if you look at mining output over time, it's been relatively consistent between just above 2,500 tons and 3,500 tons every single year. So if you look at a chart, between 2001 and 2008, mine output was on a downward trajectory, but then it began climbing. It began climbing in 2009 before generally plateauing over the last decade. I'll put a chart of the gold mine output on the show notes page so you can see this visually if you want to. But just imagine we had, in the early 2000s, we had declining mine output. Then we had a reversal with increasing mine output. And you look over the last 10 years, pretty much been flat, fluctuating a little bit, but pretty much plateaued. So to put that mine output in context, that 2,500 to 3,500 tons, gold demand set a record of just over 5,000 tons in 2025. Now, keep in mind that mining isn't the only source of gold supply. In 2025, recycling added another 1,404.3 tons of gold to the mix. So that brought the total 2026 supply to just over 5,000 tons. So basically, supply and demand in the gold market last year balanced, and it typically does. The amount of gold that's being mined tends to correspond roughly with gold demand. Now, if the mining supply starts to drop or if recycling falls, then you could see gold fall into a market deficit, as we have seen with silver over the last 4 or 5 years, where you're actually not meeting supply with you're not meeting demand with the current supply, in which case you have to tap into above ground stocks. So there's a theory that the world will eventually hit what is known as peak gold. And at that point, mining output will begin to steadily decline year after year. So, there's going to come a point where that's all the gold, that's the most gold we can pull out of the ground in a single year, and then it will begin to become less. And, this kind of makes sense intuitively, right? As you mine gold out of the ground, that gold's not there anymore. And unless you're making a lot of new discoveries, then it becomes more difficult to get new gold, right? The gold that's left underground is more difficult to get to. It costs more money to mine. So intuitively, you can understand why there is this peak gold theory. Now, will that play out in reality? Nobody really knows, because it's interesting that technology advances, so they're making new discoveries. Technology advances and they're able to economically mine gold that they weren't able to 10 years ago. So it's hard to really make any kind of real projections. Some analysts you will hear claim that there are only 15 years of reserves at the current production rate, which is true, but it doesn't account for the relatively consistent pace of new discoveries. So if you hear somebody saying there's only 15 years of gold reserves left, they're probably exaggerating to make a point, because that's just not the reality. The truth of the matter is the gold supply is relatively stable and is meeting demand. So, although peak gold followed by a decline in gold production isn't totally out of the question, it's probably not going to happen anytime soon. And while it is true that the supply of easily mineable gold is declining, ongoing technical advances, as I've already mentioned, will likely unlock some of those unviable reserves in the future. Furthermore, better exploration methods will allow geologists, that's a new word, geologists, to discover additional new reserves. However, none of this happens quickly. That's one of the things you have to understand about gold mining. It's a slow process, right? Just because the price goes up today doesn't mean they're going to say, let's get more gold because the price is higher. It takes time to make a discovery, to ramp up production, and to actually get the gold out of the ground. So for the long term, the World Gold Council forecasts that gold production will likely remain at a plateau rather than this idea of peak gold and then a decline. And the World Gold Council says, quote, a key reason for this is that the new gold mining projects are getting harder to discover, due mainly to geopolitical instability in many prospective regions, lengthening development timelines amid protracted permitting processes for environmental and social licenses, rising capital costs, and complicated project financing in remote areas. So, in other words, government policies create headwinds for gold mining, as well as the financial difficulty, the expense of actually being a gold miner. So, there's no question that the amount of gold that is close to the surface and easy to mine is declining rapidly, but advances in mining technology, again, are making more difficult deposits economically viable. The World Gold Council said technology advancing, better geological modeling, and deeper underground mining becoming more effective is making new discoveries more viable and extending the current usable supply. In conclusion, while there is a slim possibility that we run out of easy and cheap gold to mine, if all discoveries stopped, technological advancement and a price that is high enough could see gold extracted from previously unfeasible supply sources. So I just wanted to share that. I thought it was interesting, to kind of look at the supply side. We talk about demand a lot on the show. We don't talk as much about supply. And I thought that this was interesting, kind of something to think about as you consider gold. But the bottom line is it's very scarce, right? That's what makes it valuable. It's not going to get less scarce anytime soon. And if you're going to roll the dice, and try to guess, well, is it going to become more scarce or less scarce? More scarce is probably more realistic than less scarce. And again, I think you're also going to see a lot of demand pressure as more and more people are beginning to understand that investing in gold is wise, right? We're seeing this kind of shift in even the mainstream, in the mainstream investment world, where people are talking about, you might want to hold precious metals in your portfolio. We had the Morgan Stanley CIO say that maybe we should stop with this 60-40, 60% equities, 40% bond portfolio mix and go to a 60-20-20 with 60% equities, 20% bonds, and 20% precious metals. Imagine what'll happen if investors begin to take seriously the call for, 20% exposure to precious metals in their portfolio. Right now, most people have none. 1%, maybe 2% is kind of high. So if we begin moving up, even if more people get to that 1 or 2%, we're talking about a significant increase in demand without any subsequent increase in supply. So if you want real money that holds its value over time, you want gold. If you want real money that they can't just willy-nilly create out of thin air, you want to have gold. You want to have silver. So as I say every week, it's a great time to call 800-800-1865. Over the last couple of days, I think there's been some optimism that this war is going to end. We've seen gold recover. We're kind of marching back towards $5,000 an ounce. It was over $4,700 this morning. So I think you still have a buying opportunity, sub $5,000 gold. I think that's a pretty good deal. So you might want to go to Money Metals and talk to a precious metal specialist at 800-800-1865 or go to moneymetals.com. If you don't want to talk on the phone, you can chat online. Or if you know what you want, if you want to avail yourself of the specials, you can just click the link. You can order online. We will ship your product out to you. And you could even have your metals stored in our state-of-the-art bullion depository in beautiful Eagle, Idaho. But do it today. 800-800-1865, moneymetals.com. So that is the wrap for this episode of the Money Metals Midweek Memo for this week. You can get more information about everything I've talked about on the show today and a lot more over at moneymetals.com/news. If you want to get the latest news and information relating to gold and silver right in your email inbox, make sure you sign up. Join 1 million other people on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast every single Friday, where you're going to get a quick review of the week in precious metals, along with interviews between yours truly and interesting people from the world of gold, silver, economics, and investing. So, again, thank you so much for listening to the show. I hope you have a fantastic rest of your week, and I will be back again behind this microphone next Wednesday.